PE of Google and let's check the other form. Okay.
PE is same as PER.
Yeah. Price earning ratio. So price earning. Yeah. So what else? Apple. Okay. So Apple is, I don't wanna choose other industry or some in other. So Yahoo is IT sector as well. So okay, P&G, Procter and Gamble. Okay. Everyone know P&G, right? Procter and Gamble. Procter and Gamble P ratio is a little lower. Okay. HP. HP what is Hewlett Packard. Hewlett Packard's PE is 8.9. Okay. P sub ATP is okay. So it is price earning ratio, both of the price earning ratio. Okay. So what it means? So suppose for it means in case of Google, every $1 of Google makes, right? So it is P ratio for every $1 Google makes, it is like a $20 value of stock price, right? So in case of HP Hewlett Packard, every $1 Hewlett Packard makes, it is translated into just $9. Okay. So actually you can regard earnings yield, so PE, EP. So it is earning. It is called earnings yield. So earnings yield is the inverse of PE ratio. So in case of Google, it is 1 over when Hewlett Packard is 1 over. So anyway, every time you invest $1 in the Google stock, it means you have claim on the 1 over 20 of earning on the Google in some sense.
Is any kind of overvalue?
So that's what I'm about to ask you. Okay. So it is it means every dollar you invest in the HP, it means you have claim on the approximate 1 over 8 of the cash flow. And roughly speaking. Well, we have two situations, something like this. And we should basically do our invest in this case. The why? Can you explain why? Using HP to launch
I had some experience in stock investment like a few years ago after I finished my business. Okay, I just looked at the PR.
Yeah.
And when the PR is high, it has tendency to go down. And when it goes down, normally the price goes down.
Alright, so when PE is high, why do you think the stock price will go down? Tends to go down. Any idea?
I think if it's already high, then I think it's kind of bubble. Like Google is kind of an IT company, so its values are kind of people buy the stock because of its network value, but it's not just they don't actually have a solid material like HP has, because HP is a manufacturing company.
So basically, your intuition is Google's stock price is maybe too high, given its earning, right? So given the amount of earning, stock price is stock price is like 21 times of its profit, right? Stock price 21 times of profit. On the other hand, for HP, stock price is simply like 9 times of its profit. So it seems that HP is Google is kind of overvalued in comparison to HP, right? It is your intuition, right?
But I think you have to look at the industry.
Industry. So they are in the same, almost same. It is not exactly the same, but both of them are in IT sector. So Okay, that is your intuition. Any other idea? So does everyone agree to this one?
Well, I'd like to ask track record. If those Google and track record is the same.
They almost say. They not really the same, but
Yeah, Google's case, people.
okay, then let's try to use the same factor. So how about Yahoo? Yahoo is 18, okay? So it's not that different from. Okay, so Yahoo is like 18, okay? So anyway, what can you explain on this?
I don't know how industrial Google and but if those firms in industry say the P ratio of the industry would be average, maybe in this case 19, and comparing that average, then Google's case, if the price is overvalued, overpriced,
Okay.
Yahoo is underestimated.
Okay, so basically Google's stock price may be high compared with the profit, and Yahoo's stock price may be lower in comparison to Google, given its profit. It is, you have a similar reasoning. But okay, and the PE is public information. Right? So by simply googling the phone, okay, you can easily find its PE ratio. But Umar, long time no see. Okay, you miss your presentation.
Professor, I'm not a man.
It's
I did my presentation.
Oh, I'm sorry. Where is Umar? Do you know where is it?
I don't know.
You're not this right?
I think he's not in Korea. His Facebook is in. Is it?
I don't know. I don't know.
Okay. I'm very sorry. Okay. No, you are a good student. Thanks.
At the same time, I think I'm thinking Google's price is not overestimated.
So okay, Juan explained about P ratio. So anyway, basically everyone can find the P ratio of the phone. If everyone simply invest the P ratio, your P ratio is a really good predictor about your just a moment. Good predictor about the future performance of the phone. Then everyone will invest in a phone which have low P ratio. But actually that is not happening. Okay. So actually there must be a reason. There must be a reason why Google's P ratio is much higher than HP's P ratio. Why don't you try? You're a student of PS, so why do you think Google's P ratio is much higher than Apple's P ratio?
It's because of the scale of the company.
Scale of the company? What do you mean by scale of? So anyway, even when you read a newspaper, there are somehow you must say this company's PE ratio is low. So basically, we have to invest in the company, something like that. Or sometimes newspaper says that this company's PE ratio is too high, so it is overvalued, so basically we shouldn't invest. So newspaper has some sort of often provide that kind of argument. Basically, really similar intuition to both of you. Okay, but anyway, we have to understand why Google's P ratio is much higher than HP's P ratio. Okay, actually, Juan explained it already why it is high. Of course, implicitly. Oh yes. So let's go back to the P. How PE ratio is determined. So suppose there is no growth. Okay. Suppose there is no growth. So basically, P ratio is basically price over earning. Okay, so price is in some sense earning of course, suppose we give out everything as a dividend, then it looks like this. So K is basically discount factor. Maybe something like that. Right, it is like a discount factor or it is an expected return on the stock. So if P ratio is high and if stock is fairly valued, which means that Google's K, okay, so basically PE ratio is therefore from here 1 over K, right? Which means that Google's K is what? Google's K is higher or lower? Google's K is lower than P's K, right? So what is K? It is a required return.
Less risky asset.
Right. So yes, that's basically right. So we can go back to K again. So if we believe capital asset pricing model, K is basically RF, risk-free rate, plus beta, and expected market return minus the risk-free rate. Right? So if K is HP's K is higher than Google's K, risk-free rate is the same to every stock, and expected market return minus risk-free rate is this part is also same to every stock. So the only difference is beta. So which means that Google's beta is lower than HP's beta, right? And beta is indicator of the risk. So which means that HP is risky stock than Google. So because of risk return trade-off, if a stock is riskier, right, then its return should be high. Okay. So basically, if we believe this, basically what it says is the HP. Okay, basically HP is PE ratio is lower because HP is a risky stock. Okay.
So if beta changes, then the P also changes?
Yeah, of course. If beta goes up, what's gonna happen? What's gonna happen with PE?
If beta goes down.
Yeah, go down. Okay. So if PE goes down for many reasons, maybe from make more money, but another possibility that it's riskier. Okay? And we don't want to invest in risky. So we cannot say low PE stocks are always better than high PEs because of the risk. Okay? And another possibility is of course growth rate. It is R minus G, so K minus G, right? K minus G. So if we interpret this way, okay, so Google's P, so Google's P is high, which means that Google's K minus G is low, right? Google's K minus G is, so which means that Google's K minus G is low, so maybe Google's G is higher than HP's G, possibly, right? If G is high, then this part becomes small, so PE should go up, right? So another possibility is that Google has more growth opportunity, right? Google has a bunch of smart people, so we expect that they will generate interesting investment opportunity in new business. So Google will grow faster than HP.
That's why investors pay 20.
Yeah, that's so because people expect Google will grow faster. It means that they are willing to pay higher stock price, higher price for the same amount of the profit. So there are two possibilities. Actually, there are many other possibilities. So if PE is high, price earning is high, there are many possibilities. Basically, two possibilities. First, the stock is maybe overvalued. Maybe it is bubble. Okay, that is of course one possibility. Another possibility, more plausible. Okay, more accurate in most of cases explanation based on efficient market hypothesis that maybe the stock with high P ratio may have low risk, safer stock, or maybe it will grow very fast. People expect the firm will grow very fast in the future. Okay, and then it's not always accurate, but G is also like ROE, return on equity, and retention rate. Right? Something like that. So it means that growth rate is high, means that the firm will have maybe high return on equity. Because a firm has a lot of valuable investment opportunity, every equity a firm has, maybe it can generate higher return, okay, higher return from its equity, which is means the higher growth rate. Then if they have a growth rate, then P ratio will go up. So I think Google's P ratio is high because Google has, people expect Google will grow very fast in the future as well, because of smart people in Google. And then its attractiveness of its business model. What is the
How do you
question?
calculate growth rate?
What?
How do you calculate growth rate?
So there is another way to calculate growth rate. So this is accounting identity in some sense. So if you know how much it will pay out as a dividend, okay, pay out dividend, then you can calculate retention rate, which is 1 minus dividend payout ratio, and you have to multiply ROE. But this part is hard. It is very hard to calculate ROE. You can calculate historical, if you take a look at accounting balance sheet of the firm, you can find the historical value of the ROE, but actually you want to know future value of the ROE. ROE right now. So this part, it is harder.
So if I use the historical ROE, it becomes the historical.
Yeah, it is
growth
just a
rate.
history, right?
If I use the expected one, then it becomes expected growth rate.
Yes. So in many cases, so PE is kind of, okay. So in the industry, especially when I work in Lehman Brothers equity quant, PE ratio is of course very important. But when I actually investigate PE ratio, I don't simply look at the profit they already made. Okay, I take a look at the analyst forecast, right? When there are a lot of stock analysts, their out estimate about the future earning. So I use the stock analyst estimate about earning, and then I basically investigate P ratio based on that estimate of the stock analyst. So if you use that kind of stock analyst earnings estimate, then you can calculate basically forward-looking ROE.
Can I access the future earning information easily? Because I think it's very helpful to my final.
Oh yeah, it is very easy. Yeah. Oh, wait a moment. It is very easy if you have an account of the database. Which is not. But I think you can maybe, for Korean phone, I think you can find some earnings estimate in the neighbor. Maybe. Like Samsung Electronics, there are many properties for followers of Samsung Electronics, and some of the information is like So anyway, any other question? No? So, okay, let's take 15-minute break, and we will have class presentation. So who wanted to first? Any volunteer?
The investment was darkness. But now with the very good guide of Professor Kang, I think investment is my light. And I believe we all should not fear the light, which is investment. So here comes my idea. So my introduction is, so my proposition was, can I make my own index for investing in stock market? So everyone is interested in stock market actually, although we learn options and derivatives. But mostly I was very interested in stock market. And so I was thinking, why not we can make our own index? And the reason for making my own index was this. There are so many factors and variables that actually affect the stock price. And it's like chaos. There's so many and we're so confused. There's so many and more than this. So my investment idea is there's so many factors that affect stock price. So I will prioritize some of the factors which I think is important for my investment, and I'm going to systemize those factors. And by doing that, I'm going to make my own index.
So my factors are sales growth rate, net income growth rate, PER, and the market share, and the order analysis and business structure and culture. So with doing that, I'm going to systemize the index. I'm going to have the systemized index, which will tell me which stock to invest and when to invest. So I chose the most popular company in Korea because it somehow everyone in this room is related directly or indirectly. So I chose Samsung Electronics, and I had to choose investing in year 2009 because I had to show my conclusion that my investment index was right to show the profitability later. So the first one is sales growth rate, and the graphs are difficult because I used all this data from Naver and Google Finance, and also Wikipedia and KRX, and also DART, if you know FSS. Yeah. Okay. So sales growth rate. It starts from 2007 and 2011, and 2011 is the expected one from Naver. And I can see that the growth rate is 23.06%, and the net income growth rate is 29.95%. And here PER, industry average is 10.8, but I actually compare it with the LG Electronics because Samsung Electronics is a very big company. It actually deals with so many sectors of business units. So LG Electronics is the most similar company that I can compare with. So LG Electronics actually had a 9.6 PER compared to the Samsung Electronics. It was lower. Okay, next, market share. Market share, the global market share has been growing because I thought the stock price is affected even by the global performance by Samsung Electronics. So the global share is growing, and the market share for 2009, because I'm going to invest in 2009, was 19.8. Even under the financial crisis in 2008, the market share was growing. And for order analysis is I have to see the order and the stock price movement to define when to buy or sell. And this is example. For example, when the stock price is high and the order decreases, that means to sell. And when the stock price is low but order increases, that tells us to buy. But this is just the analysis. But I had to assume because I didn't actually choose one particular date, so I assumed this was to buy in 2009. And the business structure and culture. The first, I have two pictures. The first one is CEO Igani, and it says market capital increase 1,500 billion a day. It was last year when CEO Igani was back on his throne. I say throne because it's like an empire. And in one day, the market capital actually was increased by 1,500 billion won in one day. So that means actually the position that the CEO Igani has is very strong, even in international market, international stock market. So the shareholders and possible investors actually think Igani is a very strong character, and Igani makes Samsung more stable. And NPS is a National Pension Service. We actually had the director of National Pension Service 3 weeks ago. And it was very surprising to find out that the major shareholder was NPS, actually. They actually have a 5% of Samsung Electronics. And National Pension Service is the 4th largest pension service in the world. And it's renowned for its very safe investment. And we can actually see that the reason why they invested in Samsung means that Samsung is a very stable company. So these are the checklists, my index. So I actually have 6 factors, and I only have one assumption here because I had to put buy, but other assumptions were positive. So my index hypothesis is that if the 6 factors have more plus than minus, then the index is positive overall, and it means for me to invest in that company. So my conclusion is that I actually looked through the profitability, ROE, ROA, and ROIC, the return on invested capital, of 2010. And I invested in 2009, and I looked into the stock price, and also the stock price, and also the ROE, ROA, ROIC of 2010, and it was like this. So if I actually invested in LG, then I wouldn't have been much happy in 2010. But I invested in Samsung according to my own index, and I had even 30. ROE was 18.03, and the next page shows that this is for Samsung and this is for LG. It's just the stock price profitability. You can actually see that it was a negative number here. But my limitations are actually I didn't actually consider all factors, because their stock price is affected by so many factors. But I couldn't actually because I chose my own factors. It was my own preference, so I couldn't actually include inflation, government policies, natural disaster, financial regulation, and so on. That's my limitation. But as I mentioned before at my introduction, because there are so many factors, I need to simplify them, and my preference is all about my investment. And also, it does not actually reflect the stock price, because I cannot actually estimate the actual stock price. There are so many stock pricing models, but my index is not about estimating the stock price. But my index tells me when or what to invest. And also, I cannot anticipate specific profit rate. I can only anticipate if I'll be profitable or not. So that's my limitations, though. Thank you for listening. Any questions?
Okay, what is your position? Normal X or normal Y? Express your position like normal X or normal Y.
I tried to find like the variables, but then my variable was plus or minus, so I didn't actually put those.
Is the higher your index is, the better.
Yeah, it could be, yes.
Okay, so yes,
but I had to, yeah, okay. I want to simplify, but I can do that.
And where is your literature review?
Well, I didn't write it here though, but I kind of explained because other people.
Okay, that is very important. So your literature fail because you didn't do literature review, and then you didn't express properly in one sentence. And then basically your presentation not streamlined. Okay. So actually literature review is very, very important. Literature review is the element that distinguishes smart people like us from those people in the industry.
So for me, I have to look to those papers that actually try to find the index, right? Their own index.
Well, any literature just find some academic papers related in your research question and try to find how your idea and results are related with those existing academic results and how you can contribute to contribute to literature. Okay? So that is very important to people, to us. Okay, then to people doesn't do it. Okay, because they don't know how. So we have to love that.
So
literature review.
do I have to remake the PowerPoint or just put it in my?
Yeah, please make it again and make it 5 pages or 6 pages. Okay? Make you read the something. College of Economics and Finance. Do you have S? Finance.
I think I made a mistake. Okay. I'm sorry for that. Well, good morning. My name is Kim Won-song, and I'm going to share my investment idea with you all. Well, my idea starts with the question: how can I utilize the increased Chinese purchase power? As you all know, China is now the second greatest economic country of the world, following United States. And as the income of Chinese is increasing, the purchase power, the demand of Chinese is increasing. Then I wanted to find out some idea to utilize that. And as an answer, I found out luxury portfolio as a proposition. Luxury portfolio means a portfolio consists with firms making luxury goods like Gucci or Louis Vuitton, Chanel, etc. The reason why I chose luxury portfolio as my investment idea is, at first, they have global reputation. Those firms are globally known, and it means the demand on these firms is quite steady. It's not affected by some tiny events. And also, they are diversified over international. It means they have global branches all around the world, and it means their performance is not affected by some local risk, local event. And also they are diversified over industries. It means for Louis Vuitton's case, they are making not only bags but also shoes or sunglasses, watches, jewelry, almost every stuff about luxury. That's why I noted industry, and it means they are not affected by single industry matters. And plus, increased demand of China. Actually, it is well explained in this research. Actually, I'm wrong about it's not academic, but it's research explaining China increasing demand of China will go to luxury brands, and the luxury brands' performance will be very expectable. At 2007, it's quite old, but yeah. And also there are some news talking about the luxury firms' performance in China. It's new. It's only a week ago. And by those 4 reasons, I expect this luxury portfolio will outperform. So I choose this portfolio as my investment idea. Definition for analysis. It was very hard to me. How can I define luxury? A firm is luxury or not? Because I'm not luxury man. I don't have any luxury goods, so I don't have an idea which firm is luxury firm or not. So I should have researched. So I found out 2010 Luxury Brand Status Index survey on China. It is a survey for luxury brands, especially in China. It is conducted by Luxury Institute, which has some reputation in luxury area. And then I found out which firm should I choose. But there was some limitation. Some of those firms in luxury brand status index, though they are scoring very well, but they are private firm, which means their stock is not traded in public market, so I can't add those firms into my portfolio. Yeah. Then these 6 firms are consisting my portfolio. Actually, I should admit it's not well diversified or well-made portfolio, but it is limitation of myself because I'm not good at luxury stuff. So if you think you're special expert in luxury area, then you can choose some firms and add those portfolio. And so as a benchmark, I choose S&P 500. So now to say my hypothesis of investment idea, luxury portfolio will perform more than S&P 500 because of the Chinese increased Chinese demand. So the analysis for those performance is like this. When S&P 500 is performing 22% for a year, my portfolio, which is luxury portfolio, is performing about 66%, which is very high, and which seems significant. At first, the difference of those two portfolios is not so significant, but as the Chinese demand is increased, the difference is quite significant now. Well, actually, I didn't modify my portfolio. I just choose the firms and use the Google Finance's default option. But anyway, maybe I think it's my limitation to improve, but it seems luxury portfolio is performing very well. Before conclude my presentation, I should address some limitations. Limitations, not myself, but the portfolio itself. The first one is Chinese demand. Actually, the outperforming of this portfolio is depending on increased Chinese demand on luxury goods, but it's kind of human decision. There is no telling how long the Chinese demand will go and last. And the second one is European financial crisis. I said those firms are having international branches, but usually their main quarter is located in Europe. And as you know, European financial crisis, like moratorium crisis of Greece, those things are happen. If those things are happen, the investment in Europe will shrink down, and investment in those luxury firms will diminish. It will affect the performance of those my portfolio, and those two is the limitation of my portfolio. So concluding my presentation, if you want some profitable investment, then luxury portfolio can be an answer, and now is the time. Thank you for listening, and if you have any questions, then
you were mentioning about Chinese demand.
right.
When I see your portfolio, I can't find any evidence of Chinese because I think the kind of Louis Vuitton or BMW, the stock price can be goes up because of the merge of small luxury brands. So,
Okay.
you know.
Actually, yeah, that's the kind of limitation of my investment idea. But there wasn't any significant event which make those portfolio performance make very high. So I believe that it's because the Chinese demand, and also the research are saying Chinese demand will goes up, and 2007 will goes up, and it makes me think the portfolio return is good because of the increased Chinese demand.
You choose Gucci, Louis Vuitton, Dior, and etc. luxury goods. And did you find that kinds of companies' Chinese demand is also increasing? Did you find that factors? Why you choose that luxury goods? Can you explain more why you choose those?
The start of my analysis is some news. Actually, the start is I want to utilize the increased Chinese demand, and I found the news that Chinese is now finding luxury goods because they are rich now. And those firms are based on luxury brand status index survey. I forgot to address, but those firms are scoring 8.5 when the maximum score is 10 in China. It means Chinese think those firms are luxury, and they want to buy those firms' products to show I'm rich, or any other reason. And why choose luxury firms? Actually, the news made me think about this.
Also, I have the news the Japanese luxury market is also decreasing. And how about in Europe?
Well, I addressed the global reputation, right? There's a Japanese quite big market, but it's not every market they are kind of investing. Also, they have European market or American market, and Chinese market is now emerging to luxury firms. So those Japanese decreasing demand would be affect those portfolio, but I believe it's not so significant.
I can see that you want to invest in luxury goods, and I guess you have limitations too. But I don't know what kind of investment method you are trying to do, like bond or
I mean stock. Sorry for that. But it could be anything. It could be anything.
Which market stock?
Well, I don't want to limit my investment in just stock, but stock is an example. But well, I think I should find some measure to find out some way to invest. Stock is better or bond is better, but that's including that would be over. Would be excess my presentation, and yeah, that's the point. And I will find those measure and add it in final report.
Okay, so you basically found some 5 or 6 stocks outperform basically S&P 500, and then I think there is not there's no logical link to relate that finding to the offshore engineering in the Chinese market. Okay? So you need to track the link between Chinese offshore engineering and the performance of sub-brand of the US market. This is the link between them. And then I guess your proposition is like the more luxurious brand or that the better it performs.
I'd like to say the more my portfolio is luxury, consists of with luxury firms, then it will perform well.
Okay. So you failed the test, but still you strengthen the logical link between your data analysis and your research question.
Okay. Thank you.
Next.
My idea is the rank of the App Store affects the stock price of the game deal. Okay. Have you ever heard about game deal? It's kind of the largest game company in Korea, it belongs to just mobile game, not online game. And it's maybe belongs to 10 largest mobile game company in the world.
Which game did they? Which game?
Do you know Gnome? And baseball game. And they sell over 10 million seller. And it's my introduction of my idea. And how did I select cases? Because I invest my money on this company, so I chose. And what methods did I use to collect data? I use 5 data. I use statistics. It's I use Apple iTunes Store. Then I checked a lot of times the ranking, and there's kind of website that shows the application ranking. And next one is securities reports. Gameville is actually a small company, so the large securities doesn't make the report. But I found 흥국증권 made the reports, so I checked Hanguk Securities reports. And news article, there's kind of lots of news article about Gameville, so I checked. And person and bulletin boards. You can see DC inside or Naver bulletin board, you can find a lot of data of Gameville. And that's the reason why I selected Gameville. And it's my data on analysis. It's 2011 data, so maybe 2 quarters is my assumption because I cannot find it from the company's website. And the 4 round explain the performance of the game. And then the Air Penguin Xenonia 3 has good performance. And then experience is number of newly released game, because maybe the product life cycle is too short. They cannot show any influence on the future. So I think the number of newly released game is X variance, and Y is the performance of US market. And then my hypothesis is the more people use smartphone, the more the Gameville has the chance of making money. It's from the Hanguk Security Research Center, and then the blue graph shows the chances to sell their own contents, their expectation of mobile contents. And then second hypothesis is the more the Gameville shows a performance, the more the Gameville has the chance of becoming publishing company. It means Gameville made their own game, and also they also publish from the other company. And 2 games has shown the good performance. One for Air Penguin, the second one is Train City. Both are just publishing company. So it's my hypothesis, and it's the graph of the recent Gameville, and it shows that I invest my money on the middle of the April. It's the maybe midterm. At that time, Air Penguin shows the good performance. They rank number 1 in the App Store. Then the rank decreased. Then Gameville released Xenonia 3, and it rank belongs to like the top page. Maybe it belongs to number 10, and it shows the good performance. Then both game ranks decreased recently, so the Gameville price shows decrease. My idea is limitation is it's just small company and it cannot be proven by another person, and I only check only narrow view. And Korean, as I know, Korean doesn't like offer short selling, so I can only buy the stock. That's my presentation. And if you have any question, ask me. And I want to give you feedback from my idea.
Okay. So the game performance actually affects the stock price, you said, right?
Yeah.
But how do you know if the game will be successful or not?
Hmm?
If you have to invest, you said you have to buy the stock, right? But you have to buy the stock before the game is not successful, and then if you want to be profitable, then you will sell after the game is successful, right? So for example,
Could you please your question short, because I cannot understand.
you cannot expect the games to be successful or not.
I can explain. Like, if you go to GameBill's IR news, they show their quarters, plan which game they will release. So I know their killer content is coming. So if I anticipate the game will be good, I invest my money or I just sell it.
Hello. My idea is about weekend effect in Korean market. So I'm just wondering, when is the good time for having a sell position? So in the weekend market, like all the investors, like all of you, are seeking for the best profit. So I was questioning about, like, during the day, what will be the best day for like selling or buying the stocks. So my proportion is sell the stock in Wednesday, and I made this hypothesis based on the day shows the highest average returns is the best time to selling it. So my my literature bases are from about the weekend effect and from the Journal of Economic and Finance, and it says in its research about S&P 500 market during 1973 during 1997, and it shows that like in American market they are having a weekend effect, like they are good. Highest and lowest returns are observed on Wednesday and Monday. So with this hypothesis, I thought that today's Korean market will follow the similar effect as like American market. Also, I compared KOSPI and KOSDAQ, like which they are related to this weekend effect or not. So my data is from the KRX, and I get the data of 1 year data from each KOSPI and KOSDAQ. So I compared with 1 year data from KOSPI and their average returns of each like Monday through Friday, and I divided them with 4 weeks and measured their return as well. Also, second, I researched about 10 years data returns and I compared, and same again with KOSDAQ. So my methods are using Excel worksheet. I pick up each days of week data and calculate their average returns and variations. So this is my data analysis. Like as you've seen, like in a KOSPI, they're actually showing good average returns on Wednesday, and also in like 4 weeks analysis, like pretty much Wednesday has the best average returns. However, like when I see the KOSDAQ data, which is 1 year and 10 year, they are hardly showing that they have good average returns on Wednesday. They have good average returns each like Tuesday, Thursday or Friday. But when I see the variation, like they are quite high variation, like 0.91 or like 2.4. So I thought that with even in Costa, even though they have good average returns, but with high risk, so it's kind of hard to measure them like they're like reliable. So my research are kind of the researchers are quite following Korean stock market. So Wednesday are maintain high average returns, and also it's kind of hard to measure in Costa. And my limitation comes to like it's kind of hard to find why the stocks are having high average returns on like specific day like Wednesday. But I only can assume that through the literature they have like when I see the voluntary, people that tend to trade like their stock usually on Friday because of like there's like lots of information going on during the weekends. So maybe I can find more research about that to make my final paper more like reasonable. Yeah, thank you for listening.
Okay, so you mean do you have to start Wednesday morning or Wednesday afternoon?
I didn't figure out like like during the morning day or afternoon.
So please test from when we buy and when we
Okay.
So from Monday morning to Monday morning to Wednesday night, or from Wednesday morning to Thursday morning.
Okay.
And is there any similar paper?
I found like similar, but there's like no specific about like today's. Also like comparing like cost, and mostly when I see the Korean paper, they also like putting lots of facts on like Japanese stock market.
And you please check again the Korean literature, DBPR. In the library, in university, right, you do free access to DBPR. Or like academic.naver.com. Maybe that's right. Okay, any other questions?
To make a profit, I should think I need to buy the stock. So
Yeah.
I know the when
Ah.
should I sell.
Yeah, I was kind of trying to figure out like when is the better day to buying the stock, but like when you see the like their analysis, like good day maybe Tuesday or Wednesday, but it's kind of hard to like exact measure out like which is good day for the buying, like so it's like I cannot specify the buying timing, so I only mention like the sell because of like I found this analysis.
You're checking whole Kospi index, right?
Yeah.
How do you think about specific industry?
I never considered about that, but yeah, I will check it out.
Okay, no more questions. Okay, take the test. So to find the yes.
Can I do presentation?
Next week. Okay, not today. We don't have enough time. Okay, we have only 5 more minutes. So for background literature, you can do for global literature. Okay, for international literature, you can do Scholar, Google.com. Okay. And in your one of case, if you want to find related literature, maybe game, stock price, game stock, something like that. The tech buzz game, stock market prediction. Okay, so there is already related literature. Okay, so you can go to advanced Scholar search, and you wanna find search in business, administration, finance, and economics, and then with all those game, stock, there is one word, 5 word. App Store, okay, App Store, And if you are interested in Korean literature, you can go to maybe academic naver.com. So yeah, so Korean stock market and weekly. So there are related literature. Okay. So there are actually another more literature similarly yours. Okay. So you have to go over that. Okay. And how your result is different from them, and what is your additional contribution.
If you have like graphs and pictures, how do you like make them show?
There is no rule about that, so you have to create it. It's smart. Okay. And you should be selective. What do you wanna say to the people? Okay. What do you wanna say to the busy people? So again, this is structure. I mean, presentation should be very easy, right? All you have to do is 5 pages, page 1, 2, 3, 4, 5. And each page there is a question, answer, right? That's all. You don't have to use any animation or fancy color, anything, right? Just a plain Microsoft PowerPoint, just simple plain slide, and just answer this question in each page. That's all. Of course, you can choose either deductible or inductive, but they are not that different. Okay.
Data analysis can have 2 slides.
Yeah, data analysis can be 2 slides, so maybe you can use up to 6 slides. Okay, so no more 6 slides.
So no introduction page and no thank you page.
Okay, that is fine. Okay. Okay. So maybe you can include title page and thank you page. Acceptable. Any question, right?
It's a festival system presentation.
What?
I mean, there is some, there will be score.
Yes, there is a score. Yes, so I scored it already. Yes.
Okay.
Yeah. Okay, so next week you will have a final chance. Okay. Next week, if you fail next week, no more chance. Okay, this is it for today, and don't forget the quiz next week, and don't forget the presentation next week. And actually, about final exam, I added one more question. No, it is not difficult one. So, final exam.
Can you like erase the difficult one?
You are all smart, so I'm pretty sure you can do that. Okay. If you go final exam, I add one rest a bit long, number 5. Okay, so question, I mean, there's 2 ways of doing the valuation, and then 2 investment ideas, project 1 and project 2. Okay, so if you use this valuation method, project 1 will generate 100 to team 1, minus 60 to team 2. If state 2 happens, so it is, if you draw the coin, so it is head, tail, something like that. Okay. And then in state 2, if you do the valuation method 1 and do the valuation for project 1, okay, it will generate minus 60 and 100. So suppose you are a CEO, and they are teams in your organization, team 1 and team 2. So from your perspective, whether state 1 happens, state 2 happens, it doesn't matter. You always generate 40 of net profit. But allocation of wealth of the firm inside the organization is different, totally different. And project 2 is simple, it's a risk-free project. It doesn't matter whatever valuation method you use. It always fits into everyone in every stage. Okay? And my question is, in this situation, so suppose both methods are equally accurate from your perspective. Okay? And my question is very simple. Okay, which project will you choose? With what valuation method? So there are 4 choices. You can use method 1 for project 1, or method 1 and choose project 2, or use method 2 and project 1, and method 2 project 2. So there are 4 possibilities. You choose one of them and explain why you chose that set of valuation method and project. So it is world first. So there is no resource. So all you have to do is you have to use your own brain. Okay. there is no real product like product. Yes, thank you, and good luck to your final exam quiz next week. And see you.